that speed cannot happen because of FOMO or the
Right.
fear of missing out. The speed has to be intellectually honest because of the research or the pre-work that you have already done. The way to look at alternatives is this is an avenue for wealth creation, not an avenue for wealth preservation. Being a founder is actually a chip on the shoulder for somebody. Building the right portfolio construction, having a very disciplined execution strategy, and having a method to the whole thing becomes extremely crucial.
Hi, everyone. Uh, Welcome to another episode on Investor Spotlight. And today I've got a very interesting VC operator, engineer, tech entrepreneur, builder. I don't know. We can call him by many definition. He's my friend Karthik, who is the co-founder and managing partner of PeerCapital. PeerCapital is an early stage tech native VC fund based out of India, and they have invested and backed a lot of interesting ideas in the last 3 to 4 years. I think prior to founding Peer Capital Prabhakar, Karthik was actually very much associated with Chiratae Fund and Chiratae Ventures, wherein spent around 10 years. And interestingly, I was just, and we will discuss about this also. He joined there as an intern and he ended up being the managing director there. So, what a journey. And prior to that, I think he was with Intel. So, please help me to welcome him again for this podcast. Hi, Karthik. Welcome to this podcast and thanks for taking out time. And let's start. Would love to know
No,
about
thank
your
you
journey.
so much for having me, and really appreciate being here and excited to be talking to you right now.
Thanks, Karthik. Karthik, I was just going through your journey and it's very, very interesting. I mean, from Intel to a VC firm, and you actually joined a VC firm as an intern and then scaled up and then you created your own VC fund. So, if you can take us through your journey for the last 10, 15 years, that would really help us.
Sure, sure. I think I'll go a little longer as well. So I'm basically born and brought up in Bangalore, and a lot of choices that I've made have been uh, very happy coincidences to a large extent in my professional career. Post my engineering, I joined Intel, spent a couple of years there, and while at Intel, I had a choice to move to either Ireland or Malaysia because my unit in Bangalore was shutting down. This was back in 2006, 2007. And something in me said that, hey, I want to do something which is more entrepreneurial. So I actually went and told my boss that I wanted to go join some startup. And the whole startup scene was just starting off to a large extent. He actually offered me a role in a startup which was getting started with an Intel. So it was more like an entrepreneurial role. I was the only engineer, and I had 7, 8 sales folks surrounding me in that team. It was called Ideas to Reality. So that was my first brush, I would say, with what a startup would be like. But with the safety net of the mothership Intel paying me salary every month, so I still was not taking the risk as such, but I was getting a fee for it, staying close home. So I did that for a year plus. And I think that 1 year of exposure helped me reflect a lot in terms of what I kind of enjoy the most. So I realized that I really enjoy technology. I really enjoy how things get built. And I started seeing that I enjoy more of what you can build, which is actually used or which is actually put to work in the next say 2, 3, 4, 5 years. Whereas my first 3 years of journey as an engineer was more about building stuff which was possibly more kind of some part of research oriented, which would possibly see the light of day from a commercial sense, maybe much longer, much later in
Right.
tenure. I think that was one of the aha moments for me, that I like the techno business side of things. And that's when during my MBA, again, it was a chance opportunity to intern with IDG Ventures. You know, it just so happened, and I think I've talked about that story quite a lot, so I'll not repeat it. But I think it was a happy coincidence. I got a chance opportunity to intern with IDG, which later converted to a full-time role. And I was very fortunate to get that base and the platform, which helped me to understand, learn, appreciate a lot about VC, founders, how do you look at things, raising capital, investors, stakeholder management. I think that was a strong grounding. And post the pandemic, this whole entrepreneurial itch came back again. And that's where I thought, let me start up grounds up. And here we are, 4 years into PeerCapital, where we have invested in around 16 companies from our Fund 1, and looking to do more.
So, Karthik, interesting journey. Why PeerCapital? And the name suggests something. If you can elaborate more on this.
Sure. I think when I got out to start, I think there were two, three things which were very clear in my mind. That as we look at the future, capital was increasingly becoming accessible, which was a very positive thing. So, if you're a founder, getting access to angel and seed capital was relatively much easier compared to what it was maybe 10 years earlier when I started as a VC. So, one thing for me was, while capital access is easy, founders still go and choose who to take capital from, and which was the behavior pattern that you generally observe. So I believed that I could play a significant role in building something which was built in the right way, where we have three stakeholders if we look at it, right?
Mm.
One is a founder who is looking to work with you, take you on board in their journey, and create value for you as an investor.
Right.
The second important stakeholder is our investors, who are placing faith and putting money in your fund, and saying that, hey, you will do the right job of investing in the right companies. And the third one is obviously the team and the ecosystem partners that you build. I felt that there was a white space for someone who was dedicatedly seed to Series A focused,
Mm.
number one. Number two, you're able to bring uh, very practical operational experiences, especially important in the first 1 year of a founding journey. And therefore, can you create an unfair advantage for someone who's working with you to help them to gallop much faster? And thirdly, from an investor standpoint, having a very sharply defined fund size and portfolio construction improves your odds at creating a alpha return, which is what alternatives are all about. So we felt that there was a white space for that, and that's where the name Peer, where the whole idea was that we're peers in that journey, and we believe we do want to be in the trenches, work with the founders as much as they need, while giving them their operational freedom. So that's how we really started off, and that's where the whole name also came about, as peers before investors.
Right. You touched upon very interesting point, and which is that if you actually pick up a startup or a founder at an early stage, a pre-series A, seed to pre-series A and the series A, then your chances of making it very big and get into an alpha return is very, very realistic. But I also know that at that stage, because most of these startups are either at pre-revenue, they have just at the MVP level, they have just about to get into revenue and monetize. The casualty rate is also very high many times, right? Because What I have understood in my experience is that when you are at Series A, after Series A, Series B, then the larger investors will also do everything what is needed to ensure that you grow and you scale, because you have larger stakeholders on your cap table and they want you to really succeed. So you have many people to help you to succeed, right? Which is at the initial stage is little more difficult because you have a lonely journey. So how do you pick up sectors or founders? So if I ask you, you have done 16 investments till now. So let's touch upon those investments and your thought process when you have picked up these founders, because at that stage you don't pick up companies, you don't pick up business model, you actually pick up founders. And I was reading somewhere, and you were actually talking about this, that at this stage, either you pick a founder and industry, and if you have the tailwind, then you can really grow. So I wanted to have your views on this aspect.
Sure. No, you're absolutely right. I think at the seed pre-A stages, the casualty is extremely high, and you can't really not account for that. So you have
Right.
to account for that as well. But I think the ability to improve the odds comes with some amount of planning and the right portfolio construction and having a very high conviction behind your investments. And what I mean by that is the answer to your next part of the question in terms of how do you actually go about deciding. In this fund as well, Fund One, and typically as a VC, mostly we run 10-year funds where you're really looking at investing over a 3-4 year horizon, and you're looking at exiting them over the next 5-6 years. So at the start of a fund, yeah, when we all build a thesis, uh, most of the times we end up putting a very high level thesis and say that, hey, this is the meta thesis on which we'll kind of work on, where you pick some sectors and then go about looking for opportunities. What we did was we just went one level further from there and said that, hey, look, as a fund one, where do you have the highest chances of winning those deals?
Right.
Number two, what are the sectors which have a tailwind in the market? And that's a bit of research, and that's a bit of extrapolation and our own instinctive yeah, perspective that you need to add in as well. And that's what creates the differentiation from one to the other. We believe that there are two mega trends which are happening, and I'm talking about the year 2022, late 2022, where we said that one, the India consumer story is intact for the next 3-4 years for sure, where you will have many new companies which will emerge. Um, Online commerce had kind of penetrated if we look at between 2010 and 2020. And we said that 2020 to 2030 will be more of that, but there will also be more brands that gets created, and there'll be more space for consumption. Given purely the math of GDP is growing, per capita is growing, where does that consumption kind of grow? And on that, we layered the aspect that we do not understand how to underwrite a brand, but we have experience and networks of underwriting enablers of that, which is where we've backed marketplaces, we have backed commerce platforms, B2C commerce platforms in the past. So we said, the next phase is going to be more about enablers of this consumption story. And that's where one trend or one theme for our fund came about, which is consumption tech enablers. This encompasses marketplaces, encompasses supply chain optimization, anything to do with product discovery, anything to do with enabling better payment abilities, and so on. So we said that's one theme that we will look for, and where are those large markets? The second theme that we started looking at was around SaaS, which graduated into AI, where we said that the next phase of growth in SaaS is there's a lot of AI which is coming in. Obviously, we couldn't predict back then that the agentic flow will be the in thing so soon. But our thesis back then was more simplistic to say that SaaS and the introduction of artificial intelligence will only make more of the SaaS easier to build, and therefore you'll have more opportunities in that space. And then we went one level down on that as well, and we said we'll pick those themes in a few sectors, and we said we'll look at SaaS and AI in commerce, gaming and entertainment, healthcare, and finance. So this is one way where we said that 3-4 years, this is what we'll kind of underwrite. And then we started going deeper, building micro theses in each of these. And as we kind of built the portfolio construction, that was one of the guiding factor. Then you overlay, like you said, founding teams. How do you back the right teams? That's obviously a bit of, I would say, science and more art than science. There you're really looking for, are the founders convinced enough of a problem statement? It could change, it could evolve, but how deeply have they researched about a problem statement to be able to have the conviction to spend the next 10 years solving that problem? And is that a problem worth solving over that much time frame? Is there evolution that will happen? Is there a large enough market for that today? Is that growing? Is there a tailwind for that? What are some of the regulatory aspects? Is there a regulatory tailwind or a headwind to that space? And then ultimately, is there a method to this where you can actually build a profitable unit economics and therefore over a period of time build a profitable business? I think those are some of the factors that we try to apply in various forms and shapes. There's a lot more nuance to that, but that's how we kind of applied top down. And then you start sourcing bottom up through networks, through relationships, and the fact that you're articulating this is your strategy, and the fact that this is where you have some past experience, possibly helps you to move faster on some of the deals. And at these stages, I guess the one of the biggest reasons why you get into some of the best opportunities will be the speed to your decision.
Right.
And that speed cannot happen because of FOMO or the
Right.
fear of missing out. The speed has to be intellectually honest because of the research or the pre-work that you have already done on that space.
Right.
And the only decision that you're doing when you meet a founder is this the founder or the founding team which matches that thesis? So a little bit of prepared mind, I would say, is what gives that ability to be quick to decisions.
So we'll just come back to the consumer sector. And I was reading a report some time back and which said that just the consumer sector as a sector will help India to double its GDP by 2032-33. And you were thinking about that the consumer space will really be there at least for 3-4 years when you had started this thesis in 2022. And what we see is that it is actually becoming much larger, wherein you are having M&As around you. You see the deals getting closed. And I think this is just a start because the global larger players will come and start acquiring a lot of interesting brands in India. But what has changed, Karthik, in last 4 years? Because you are talking about enablers, tech enablers into consumer sector per se, which is logistic, which is the marketplace or the tech enablers. I think if you can name some interesting insights or give us some interesting insight in terms of what was there in 2022 and what are the purple area now in terms of the consumer sector, because I feel that we have not even started in the consumer sector. And just one point to this, I can ask this later also, but if I just add, what do you think that the next big growth for all these homegrown consumer products which we have, be it in healthcare, be it in cosmetics, be it in food, be it in I see a lot of interesting protein brands now coming out. Do you think that the next big thing is the export for these Indian brands uh, and go global and go cross border? What's your take on all those two parts?
Sure. I'll answer the two parts. First part being in terms of how things have evolved or changed from 2022 to 2026. and possibly the way forward. I think, like you rightly said, I think the case is only strengthened more and more. If we see today how the global economies in terms of macroeconomics are evolving versus the stability, relative stability, I would say, of the macroeconomics in India, which leads to the purchasing power and the propensity to consume, which is expanding. So you have a gradually growing base of that consumer market. What that is leading to is, back in 22, I would say, I don't remember the numbers exactly, but we had done this math. There were a certain, tens of millions of users, and everyone was talking about building for the next 100 million or next 200 million.
Right.
Today, everyone's talking about building for the next 400 million.
Right.
And if I just correlate that, it means that that next 100 million thesis that people were talking about is almost assumed to be hygiene today. You anyway have to be building for that.
Right.
Now we are exploring how do you build for the next 300, 400 million. So clearly that consumer market and the demand expansion in terms of the breadth or the surface area of that opportunity is expanding. That's one.
And is it because of the higher aspiration for the Bharat in tier two, tier three cities wherein everyone wants to be associated with a brand, start using products? Is because of that the market is expanded?
I think it's a combination, but I wouldn't just trivialize that to say that it's just the aspiration. This whole thing about tier two Bharat is aspirational, is talked about multiple times. But I think tier two Bharat continues to be value conscious as well. So is tier one Bharat, I would say, except for some of the early adopters. India is value conscious. That aspiration factor definitely is there. But I think the factor which is substantially changed is the access factor, which means the better infra, the better networks, the better ability to access some of these regions has also made the products or the brands to be able to be accessible to these markets
Got it.
much more easier. And we have all the headline numbers, right, in terms of how many airports are there, how many, how is the road infra, how is the travel infra for people to actually reach. Nothing stops you, from staying in a tier two city today for the better quality of living while you're still possibly having a business in a tier one city. Uh, and I know of many people who are doing that around Bangalore itself. I'm sure there are many people who are doing that outside. That's just in the tech industry I'm talking about. Now, if you look at some of the other markets, there is a natural growth that we are seeing in terms of brands clearly seeing that there is a market in this tier two, tier three market as well. And I'll just take an example for that. I just visited a place in Uttarakhand earlier this year, closer to Haridwar, called Rudrapur. And this was the first time I was going into some of these areas. I actually went to Rudrapur. I went to Haldwani. I went to meet I actually went for a wedding in Haridwar, and then I went around. I went with a friend. Um, but it was amazing to see that the infrastructure and the brands which are there is no less. Why should you actually be going and, yeah, putting yourself through misery in terms of pollution and others in a tier one city when you can get everything there? So I think it's more about access, more about the infra enabling some of that, which is driving this.
So do you think the quick commerce has really helped in making all these products more accessible to consumers?
I would say quick commerce is a different story. Quick commerce has actually made convenience in a tier one city. I'm still not sure if quick commerce already has a strong play in some of these tier two, tier three markets. But I think quick commerce story is a lot more about density. And in a tier two or tier three market where your density may not be that high, I'm not too sure how that plays out. Time will tell.
Right.
but the density of demand in a tier one market makes it conducive for the quick commerce players to really
So
scale.
I was just talking to someone with one of these quick commerce, and a very interesting thought came in, and we were discussing about that rather than talking about a particular city, that this city would give us would help us to have a positive unit economics. Rather than that, uh, why don't we target pin codes, right? Because, for example, there may be some pin codes in Bangalore itself, which the average order size will be much higher compared to other pin code in Bangalore itself. Why I'm saying is that so I was born and brought up in a place called Dhanbad in Jharkhand. I had gone home, and I was sitting with my dad, and he said that let's order something from Blinkit, right? So Blinkit had reached Dhanbad. Now I was very excited. Why, how? And then I was talking to someone at the senior leadership, and they said there are some pin codes we are in the experiment zone, that these pin codes may give us higher order average or ticket size. But I completely agree with you. Quick commerce is a different story. What I meant was that it has become very easy for consumer to get these product accessed, and also somewhere for founders also to build consumer products and launch quickly through these platforms. I think which was very difficult, say in 2022, 23, wherein you have to figure out the distribution also, you have to figure out a lot of stuff at your end uh, if you want to really launch your own consumer product.
100%. I'm totally in agreement with that. I think the enablers are making it more and more easier,
Mm.
which takes me to that conviction that I think this is only growing even more if
Right,
we look at the next 4 or 5 years.
right.
I hesitate to say what will happen in the next 10 years, but I think the world is changing so rapidly. But clearly, at least the next 4 or 5 years,
Mm.
uh, this is only growing even bigger.
Right. So let's talk about some other aspects. So, what are the sectors you feel which will drive a lot of growth in the Indian startup ecosystem? And would love to know your take. Are you also invested into deep tech, and your take on other sectors?
Sure. So as a sector, see, one, clearly we talked about the consumer story. So I'll kind of leave that. That anyway is there. So there is a
Mm.
very strong growth in the domestic consumer story. So opportunities there are continuing to be there.
Right,
Now, the key question for us as tech investors is we kind of ponder on what are the next set of tech enablers for this,
right,
which are worth kind of backing. Because we are trying to strictly stick to our swim lane of tech
right.
and not get into the non-tech aspect of things. While there is an immense growth opportunity, like I said, you're trying to define your swim lanes is extremely important. So
Mhm.
that's one. The second meta thing is, I think there are enough problem statements uh, with India as a country. And enough areas where technology can play a huge role.
Mm.
Uh, that brings you to things around healthcare, things around education, and then it starts getting into the deep tech side where we have not been investors in deep tech so far,
Right.
but clearly see that as an emerging theme. We've been studying that a lot to understand, appreciate, and build our
Mm.
muscle in terms of being able to underwrite something, and we'll hopefully do that very soon. But if I kind of just drill that down to say that if the next wave of consumption story in India has to kind of become even larger, the enablers of that will actually be some of these, which is advanced manufacturing capability,
Right.
which will help you to build those products where it may not be, yet another, for lack of an example, yet another ice cream brand, right? Even for that, you need a lot of, components which are involved. right? And you talked about protein supplements. It's non-trivial to kind of come up with some of those. Today, what's happening is I think there are many brands which are there, but I'm sure this will evolve into a lot of specificity of how you're sourcing those products, how you're creating the traceability, manufacturing capability to build products which can be consumed in the market. Then you get into other areas around robotics. So there is definitely a lot of opportunity, and clearly space tech has taken off in a big way that we keep talking reading about. Uh, how do you expand on that is another area. But I think at a meta level, the consumption story in India, and then you're making in India, which effectively means there's a lot of technology components and deep tech that comes into play there,
Right.
will be defining areas as we look at the next 4 5 years
Karthik,
again.
I touched upon this and I wanted to have your views on this. I see a lot of Indian brands, Indian consumer brands are looking to expand cross-border, right? Uh, Obviously, there are challenges because you need to go and first do the prototype in terms of how the market will accept you, maybe list on some of the e-commerce players, see the market acceptance and move ahead. But what has been your experience in terms of some of the consumer brands who are actually trying to go global? For example, I know a brand, I will not name them as of now, but they are into women luxury wear and ethnic wear and Bombay based. They have opened they were exporting to US and now they have opened couple of stores there, right? So what has been your experience there? Because that's where I feel a large growth will happen for Indian consumer brands.
Yes, so that's definitely an expansion strategy, I would say. But there is immense opportunity in the domestic market itself.
Okay.
But just sticking to the international expansion part, yeah, there's definitely a revenue expansion and market expansion opportunity. Simple reason being the paying propensity and also the demand for these products
Hmm.
is definitely there, not just with Indian diaspora, but also outside as well. In fact, we have a company in our portfolio called Fabriclore, which is actually a B2B platform for apparel designers and boutiques who want to procure Grange fabric and get them printed and dyed as per the designs that they are looking for. But more often than not, typically they end up with higher MOQs that they have to order, or they end up with a lot of wastages. So what this platform does is they offer you a platform which is helping you to visualize the design and print, even before they buy, so that they can actually go out to their customers and go promote a certain product which is not yet created. And based on the demand, they can actually order the Grange fabric and get that printed and dyed and get that delivered so that they can then take it, cut it, stitch it, and create the final apparel. So a lot of the boutique customers for them are actually outside India, because they see this is a convenient and a very high quality, trustworthy, economical option to choose from. So, and some of those will create that opportunity set for these companies to expand, because there is demand outside as well. But while there is demand outside, I think one word of caution I would always say is that to go with a strategy rather than just saying that, hey, look, we have demand, let's just go into those markets.
Got it.
Uh, the international markets are, while the revenue is also high, your costs will also be high. So there is a risk of making a mistake of spending a lot in the hope that you will earn revenues. So having a very defined strategy and approach to a market entry leads to higher probability of success in that.
Great. Now let's jump into something else. And I think for sure that in last 6 to 8 years, investing into startups has also become an asset class. And it has got its own journey. It got evolved. There was a lot of euphoria in 2020, 21. Everyone wanted to invest into startups. And then something happened 2020 to 23, 24. There was a meltdown. So if we want to create a playbook now for someone who wants to deploy money into startups, someone who is from a traditional industry, who runs a factory or something, who has got very traditional money, and he wants to invest into startups, right? He sees a lot of things in newspaper and in media, because media really covers Indian startup ecosystem for the last 3 years. They've really started covering, right? What would be your playbook step 1, 2, 3, 4, and what should they do in terms of if they want to go and invest into this asset class?
Sure. It's an interesting question because I've been doing some of this LP management and raising capital from Indian investors over the last I would say 14 years, and the market has evolved substantially.
Right.
Uh, when I first started interacting with investors in India back in 2013, 2014, uh, it was a direct reject to say
Hmm.
that, hey, look, who's going to do this? Uh, but today, like you said, 21, 22 saw a surge of that. I would only say that these are cyclical in nature. Markets go through these ups and downs. We are still in that infancy of seeing the outcomes of exposure to alternative asset class, and it will kind of stabilize. It may take another 10 years plus, but it'll kind of stabilize into a stage where the asset class will be very clearly established, and there'll be clear norms in terms of how people access the asset class. Today, there's a lot that the regulators have done, the market has done, the industry players have done, and the traditional family itself has done. But there's still a lot more ground to cover on that, and I'll tell you what I mean by that. Uh, a lot of times, like you said, the exposure to the alternative asset class by and large today happens because of FOMO, or because you have read about it in the news, which is actually how many years back public market investing was also.
Right.
Many years back, that's how real estate investing also was. Over a period of time, things have matured, people understand and start creating a method to the whole thing. I would give the same analogy and say that's what will happen for the alternatives as well. Uh, and any investor who believes that they should have alternative exposure, typically I feel goes through certain phases, and you have to experience that to be able to get to the final conclusion. And here's what I believe, many people go through, and this is what I've had interactions with many investors, family offices who have gone through that journey. The first step is always to say that, hey, let me kind of just invest directly because I'm getting access to deal flow. So we'll start investing in a few companies. It's great, but given the bandwidth available and how you look at some of these investments, even the access and everything, typically that initial exposure is 1 lakh, 5 lakh, 10 lakh, and so on. People start with that, and then it takes 4 or 5 years to see that outcome. And then you suddenly see that, hey, this company where I invested 5 lakh, it grew and it gave me 2 crore. You're very happy about it. But if you're someone who has a net worth of 100 crore, it's a non-needle mover for you. Then you start saying, okay, how do I expand this more? But by then, you've already done so much that many other companies have possibly not worked out. So
Hmm.
at an aggregate level, this thing of being very opportunistic about investing when there is some news about it and not investing when it's not, invariably leads to overall portfolio not giving you the best outcomes.
Right.
At that point, you come to a conclusion that, hey, either I need to do this in a dedicated manner, so let me set up a family office, or let me just park money with some fund manager who does this for their living. The second alternative will be, hey, look, this is not an asset class worth investing. Let me not do it.
Hmm.
So unless you've kind of gone through this cycle where someone's kind of explored this 2, 3 years, it's very hard to appreciate the nuance of investing in the alternative asset class, because there's no index here, and you can't just invest in an index and expect to create outcome. So that learning curve is something which takes time. And I think the playbook that I typically try to look at is, when you're interacting with someone, the first questions to ask is to understand the motivations. Is it purely financial return? Is it something else? If it's a combination, having that expectation setting right is extremely important, because invariably the expectation setting ends up being that, hey, this is an alternative asset class, this will create you 50%, 100% IRR. It's rarely that at a portfolio level. So you got to be very clear on the expectation setting, make sure they're aligned with the goals, and looking at this from a long term perspective, because there is illiquidity, and only then look at raising capital. So that matching of the minds is extremely important before you actually raise capital.
And tell me something, at what level someone would think about becoming an LP into a fund, right? And just give me some insight in terms of who should even think about becoming an LP into a fund, right? I understand that, and this is the journey which everyone, all of us have gone through, that we get a lot of deals and our friends are investing, and okay, fine, I also want to invest 10 lakh rupees, and you invest over the next 3 years, you invest 20, 30 of those, and suddenly you will see that one or two would have survived or grown, and rest have actually been failed, and they've not done anything. And there has to be a method to this madness, because and then you realize, no, I think you are in two minds, and you yourself said that, a, let's stop this because I'm not an expert on this, let me make money where I know, I understand, and do it. B, there has to be a method to this madness, and let me go and talk to someone like Karthik, and hey, Karthik, I want to invest and I want to become an LP. But what are the steps to that? You talked about the horizon of 10 years. If you can just throw some more light on that, so someone who is actually watching this podcast would understand that tomorrow, if I want to become an LP, this is what I need to do, and this should be my thought process.
Sure. I'll use some of the international norms and what we've kind of seen as markets which have evolved.
Mm.
Typical thumb rule that most uh, developed markets have kind of adopted is, from a portfolio construction perspective, your investable assets, you take around 10 to 20% as exposure into the alternative asset class. So that's what one typically looks at. And therefore, if you have to have a meaningful exposure to the alternative asset class, someone with investable assets, and what I mean by investable assets is to exclude your place of residence, and yeah, any immovable kind of stuff which you can't really liquidate immediately, right? So investable assets being at least a 20 crore is a base starter in my mind. That's when you should start looking at it and say that, hey, look, there is around 2 crore to 3 crore which I can kind of set aside for my alternative exposure, and then start building on that. So that's like the bare minimum, which is important to have before you start looking at this. Otherwise, I would always suggest that there are better avenues to kind of first create that base and then look at the diversification. The diversification clearly adds value, because if you do the right thing of deploying that 2 or 3 crore, which can generate a 30% plus kind of IRR, it becomes a needle mover in your overall wealth creation. So if you look at purely financially, from a family office or an HNI, your goal is really about a combination of wealth preservation and wealth creation. So the way to look at alternatives is, this is an avenue for wealth creation, not an avenue for wealth preservation. But at the same time, the exposure should be meaningful enough so that when it creates that wealth, it's a needle mover. But at the same time, if it is actually not doing its job, it's not something which is disrupting your portfolio construction for yourself. And that's where that 10 to 15% number is a very good thumb rule to have. Depending on the bandwidth, your attention to it, your passion for it, and the exposure and understanding of the space, you can increase that percentage of exposure to the alternatives. But 10 to 15% would be a good thumb rule to have.
So it's like a ultra small cap, right? Wherein if you structure this from a public market perspective, so 10 to 15% of your overall net worth should get into this. And what you meant is that if you don't make anything out of this, it should not hurt you, right? It should
Right.
always be something which is like a balancing figure. When if does very well, very good. And I was talking to someone some time back, and he started investing a lot in 2021, 22. And I keep going to 21, 22, but that's the recent memory. And he actually started investing a lot of his uh, comfort money into that, in the sense that he was a CXO level people at many level, and they did it as a group. And they were saying that now I mean, it's been a mistake by them. So I think thanks for this, because this will open up eyes for a lot of people and insight. And we have to look this purely from an asset class. I keep telling this to people, and not just do one off investments here and there. That doesn't make sense. I think the last point, Karthik, which I want to ask you is about, and I think this is also a change which I see in the last 5 6 years. Pre-COVID, during COVID, after COVID, there was always overdose of global capital into Indian startups, right? And to a point, if you see, almost 85% of the capital which was raised by startups in India a decade back was from global capital. I mean, and now I see, and which is very, very interesting, is lot of homegrown mid-size VC funds are coming, and lot of these VC firms are being started and run by GPs who have themselves built, exited family offices. So that's a great change. What is your view on that? And do you think that this will continue to happen, wherein more and more domestic capital will get into Indian startups?
I absolutely think so, and it's actually good for the ecosystem. Yeah, and the reason for this is fairly simple. I actually recently wrote about this in an editorial opinion on money control. But effectively, if you look at it historically, a lot of that capital will flowed into India. Came from the perspective of India as a large demography, and there was a lot of free money, that you may call it, which was available, which was actually flooding the market,
Hmm.
and some part of that found its way to India as well. And thanks to that, we were able to kind of re-kickstart the whole venture and the startup ecosystem. If you look at it, the venture investing startup ecosystem started way back in the 90s
Right.
in India. But this kick of additional capital flowing in between, say, 2014 to 2018 or so, really created a lot more of the catalyzing of this ecosystem.
Hmm.
But how things stand today, from geopolitics and how capital flows are globally as well, a lot of capital is looking at staying onshore versus going offshore. And to that extent, domestic capital clearly is seeing opportunities here. Uh, the startup ecosystem is only growing bigger and bigger. The talent pool is only becoming smarter and smarter. The entrepreneurial ecosystem also catalyzed substantially by some of the government initiatives as well, is creating this whole thing about entrepreneurship as a very positive thing. I was recently reading or listening to some podcast where I think Anupam Mittal had talked about this, where 2016 ke baad, even in the marriage market, someone who's a founder was well respected.
Right.
Before that, it was seen as a risk, right?
Right.
Now, I would say 2025 ke baad, I think being a founder is actually a chip on the shoulder for somebody. Being in a startup is also a great thing. A lot of people who are joining startups are also seeing the value of ESOPs because
Hmm.
a lot of that value is also created. So some of these have that percolation effect, and therefore, I think it all flows from the ability to absorb this capital. There is a growing base of domestic entrepreneurial mindset, and therefore there are avenues for the capital to deploy. But time will tell whether the capital creates ROI,
Hmm.
because it is also very unforgiving. It still follows a power law. It doesn't mean that you invest in 100 companies, you will be guaranteed for a great outcome. You may still have 5, 10 great logos in your investment of 100 companies. But if you have not done the right kind of portfolio construction and deployment of capital, even those 5, 10 logos where you've invested, even if they create stellar outcome, you may just be getting your capital back. So while there is a lot of opportunity, building the right portfolio construction, having a very disciplined execution strategy, and having a method to the whole thing becomes extremely crucial. And that's what I believe will differentiate one from the other in the years to come.
And I think that's where a fund like yours will play a big role, because you have everything which is needed to create the right portfolio construction, and you have used portfolio construction 12 times in this podcast, so I really understand why you put so much of emphasis on it. Because if you don't do it, then the chances of your growth from that portfolio really gets reduced, right? So I think funds like you, and funds which are really very India centric funds, who really invest into Indian startups and who are very much part of the ecosystem, you have seen your own journey for the last 15 years, will make a big difference. So with this, I want to thank you for coming on our podcast today. It has been so insightful, and I think with this podcast, founders and investors who want to invest into Indian startup ecosystem would get a lot of interesting insights. So thank you for joining in, and do take care, and all the very best for your fund and your future expansion. And I think you will create large dent into the startup ecosystem, which you have already done in many ways. But I think this is just the start of the larger journey, which all we all will have. So thanks for joining in, and take care, and see you.
Thank you so much, Alok, and really appreciate for all the kind words. And we're just starting off, and really excited about what lies ahead over the next 15, 20 years.
Thank you.
Thank you
Thank you.
so much.
Thank you. Take care.